For years, traditional finance dismissed cryptocurrency as a volatile playground for speculators, not a serious asset class, but in 2025, the narrative has shifted. Boardrooms now ask not if, but how to engage with digital assets. Crypto's market cap has soared past $4 trillion, driven not by retail frenzy, but by the deliberate entry of major financial institutions. Bitcoin has surged beyond $126,000, and Ethereum has shattered records, both supported by deep institutional liquidity. This isn't the chaos of past cycles, it's a mature, measured ascent. Nearly half of all Bitcoin trading volume this year comes from institutions, a seismic shift. The market is now shaped by long-term strategies, risk management, and institutional analysis. The fear of missing out has become the fear of being left behind. The smart money is no longer on the sidelines, it's actively shaping the future of finance. This is about more than buying an asset. It's investing in a new technological paradigm. The migration of capital is quiet but monumental. The game has changed, and the players are bigger than ever. Institutional adoption is building a foundation that can absorb shocks and sustain growth. The numbers tell the story. Crypto is no longer a fringe experiment, it's a strategic imperative for the world's largest financial players. The era of skepticism is over. The era of strategy has begun. Institutions need clarity, not chaos. For years, unclear regulations kept trillions out of crypto. That's changed. The Genius Act and the proposed Clarity Act in the US have created a clear legal framework for digital assets and stablecoins. Assigning oversight of Bitcoin and Ethereum to the CFTC gives institutions a familiar regulatory home. Stablecoins, now legitimized, are being integrated into core operations for settlement and treasury management. With regulatory green lights, institutional interest is turning into action. Over 3/4 of institutional investors plan to increase digital asset allocations in 2025. The legal barriers are falling, unlocking a wave of planned investment. The era of regulatory uncertainty is ending. Institutions are entering crypto with confidence and compliance. The door is open for big money to flow in. Institutions want familiar tools, not technical headaches. The launch of spot Bitcoin and Ethereum ETFs in 2024 changed everything. Now institutions can buy crypto exposure as easily as buying Apple stock. No private keys, no new custody risks. ETFs removed the biggest barriers, triggering a surge of institutional capital. In July 2025, global net inflows into crypto ETFs hit $4 billion in a single week. Major players like Wisconsin's pension fund, Abu Dhabi's Mubadala, and Millennium Management are now in the game. These are strategic, long-term allocations, not speculative punts. Yet, less than 5% of spot Bitcoin ETF assets are held by the largest institutions. Most big capital is still preparing to enter. The ETF was the key. The real flood is just beginning. The initial inflows are only a preview. The institutional era is just getting started. Bitcoin headlines, but institutions see beyond, into DeFi and tokenization. DeFi is a parallel financial system offering lending, borrowing, and trading without intermediaries. In Q3 2025, DeFi's total value locked soared 40% to $161 billion. Institutions are drawn by new yield opportunities and financial innovation. Tokenization, turning real-world assets into digital tokens, is gaining traction. 76% of financial firms plan to invest in tokenized assets by 2026. Infrastructure is maturing fast. Ethereum's upcoming Fusaka upgrade will boost scalability and cut costs, making DeFi and tokenization more viable for institutions. Major banks are developing their own stablecoins, building tools for the tokenized economy. Institutions are investing in assets and building the rails for a new financial system. The future is programmable, open, and global. Bitcoin is now a treasury reserve asset for public companies. What began as a niche move is now a credible corporate strategy. Companies are using Bitcoin to hedge against inflation and currency debasement. Since mid-2024, public company Bitcoin holdings have surged 120%, now totaling over 859,000 BTC, 4% of all that will ever exist. Fortune 500 adoption is rising, signaling mainstream acceptance. Bitcoin is becoming a core part of modern treasury management. These companies are long-term holders, not traders. creating steady demand and reducing supply. Their moves normalize Bitcoin as a legitimate financial asset. When iconic brands add Bitcoin to reserves, it sends a powerful message. This is a new digital gold standard. Corporate adoption is reshaping the market. Bitcoin is now a serious asset for serious portfolios. Despite new highs and headlines, we're still in the early innings of crypto's institutional era. The infrastructure is built, regulations are clear, and pioneers have crossed the chasm. The next phase is a slow, massive reallocation of capital that will define finance for decades. Institutional capital brings stability and long-term focus, dampening volatility. Predictions of Bitcoin reaching $160,000 or more are grounded in real capital flows. As pensions and endowments allocate even 1 to 2%, the impact will be unprecedented. Global uncertainty and central bank moves only intensify the search for inflation-resistant assets. Crypto is now seen as a digital haven by the world's biggest asset allocators. The convergence of regulation, products, and macro trends is driving adoption. Institutions aren't just buying crypto, they're buying a stake in the future. The risk now is being left behind.